We're going to look at qualified plans like 401ks or IRAs, your traditional retirement plans, versus a Roth, versus the benefits of an IRP. I'm assuming you've been fortunate enough for someone to approach you about the IRP plan. Not very well known, and when you see the advantages to this, it really should blow you away. So let's just kind of talk about the advantages and disadvantages of each of them. The 401k or IRA this is the reason they're popular, is because they are tax advantaged. Let's put a little bigger X on there. They're not tax-free distributions. There's no death benefit. There's no critical illness benefit. They do have limits on their contribution, which really isn't right. I mean, imagine you're the owner. You have introduced a plan for your employees out of the goodness of your heart, and you can't put in as much as you want in your own plan. Now, that's a real disadvantage. Another one is market risk. We'll get into that in a minute. Now, the Roth doesn't have advantages for contributions, but it is tax-free distribution. And it is an IRS design plan, and they can change the rules when they want. There's no death benefit, no critical illness. They do have limits, again, on contributions, and there's market risk. Now, the IRP is a special plan. It's got tax advantage contributions. It's tax-free money. It's got a death benefit. It's got a critical illness benefit, and there are no limits on contributions. Well, actually, the limits are in the upper millions. So for all practical purposes, we're going to say no limits. And there's no market risk. Now, let's talk about market risk first. Time magazine did an amazing story in October of 2009 called Why It's Time to Retire the 401k. I do urge you all to read it. Now, one of the things they talked about in market risk was that you could plan all your life for retirement and be a year or two away from it. You've contributed all your life, and just when you're just about ready to retire, if the market tanks for 1, 2, 3 bad years, your dreams are up in smoke. Can you imagine planning all your life and not knowing the outcome of what's going to happen? Can you imagine running your business the way your retirement plan is run, not knowing the outcome, not knowing if you're going to make money or not, totally outside of your control? I can't imagine why anyone would want a plan like that. And the answer is simple, is because nobody knows their options. So let's talk about the market risk, and I'll show you exactly how it affects you. We're going to do a little example here. The red side is the 401k. It's tax-deferred money. IRAs, it's where you get all the ups and the downs, and it's based off the S&P 500. Now, keep in mind this is the top 500 companies in the country, and most brokers, over 75% of them, don't even do this well. So please keep that in mind. On the blue side, it's an indexed UL policy. It's a life insurance policy designed for retirement. It's got a cap of 13% and a floor of 0. Never goes below 0. You never take a loss. So we've got an example here of a 40-year-old male, $100,000 on both sides. So here's what happened in 1999. Market had a good year. It had almost a 20% gain, and it's reflected in the red account. On the blue side, the life policy only had a modest gain of 13%. But then you had the dot-com bubble, you had 9/11 come along, you had 3 bad years, your money drops to 71 grand. Over here, we still held. Those zeros became a support, and the account stayed at 113,000. So it goes up and down, as you can see. You have better gains on the red side and more modest gains over here. But look where we are 10 years later. You've had your money in the account for 10 years, $100,000. 10 years later, you're at $73,000. Guys, that's ridiculous. How can you plan your life or your retirement like that? Look on the blue side, $167,000. So up and down it goes on this side for 15 years. Actually, this used to be a 15-year indicator because it gives us an accurate predictor of history. We're keeping it going, and now we're at 16 years. So the end result, you end up with $167,000 on this side, and here almost $304,000. Now, notice the average gain is 5.4%, 5.04%, and that's really statistical numbers. It's playing games with numbers because that's this side. Where the real numbers is this side. That's what your money actually made, 3.28%. On the insurance side, 7.2. But we're not done yet. We've got fees. Average fees are said to be about 3%. You had to take out taxes, and we're really conservative on taxes, folks, because what are taxes going to be when you retire? We know in the future they're only going to go up. The government's broke, and they're starved for tax money. So they're going up, the house is paid off, and the kids are gone. So 30 is very generous. We know it could easily be double that, 15, 20 years. So when it's all said and done, 16 years of investing your money, white knuckles as the market goes up and down, you're about to get an ulcer during the bad years, you end up with $81,000 of spendable money. Guys, that's pathetic. That's what you're in. That is where your money is over here. On this side, there was a cost of insurance. No taxes, $266,000. Guys, a 329% gain on your money. Why would you ever want to be on the other side? Now, let me show you a real-life example. We're going to continue this quote right here. So what we've done, let me show you how we're going to come up with these numbers. We've got the 401k. We're going to deposit $100,000, and we're going to assume this employee is contributing $200 a month, and there's matching funds of $200 a month. All right, so you got $400 going into this account every month. Now, on the insurance side, we call it the IUL, we're going to start off with half the money, $50,000. And there's no matching funds in this one, only $200 on IUL. Now, here's what we're going to have to do with this $50,000. We can't dump it in on day one. It's got to be put in over 5 years. So we're dividing it over 5 years, $10,000 a year, and that ends up being $833 a month. But then we're going to also add the $200 that the employee normally contributes for the first 5 years. So let me show you how this plays out. Here's what we've got. First 5 years, an extra $10,000 each year. And then it settles down to $200 a month. Now, look over here at the death benefit, $453,000 in death benefit. So let's go up to here. Your death benefit on this case is, $453,000. Now, your critical illness benefit, we've got policies where if you have a heart attack, stroke, or cancer, which 7 out of 10 Americans will by age 65, you will be able to draw out a lump sum benefit up to 90% of this, depending on the age and severity of the condition that you've had. So let's go back to this. So here we go, $50,000 extra the first 5 years, and then $2,400 a year. When you turn 66 years old, you're able to draw an income of $55,000 until your age 120. Okay? So, and notice there's also a death benefit in addition to it. So, $55,000 a year of tax-free money, guys. Uncle Sam is not in your back pocket in this policy right here. So, let's go back and see if you were going to draw that same income on your 401k, what happens. So here we've got $200 with matching funds, $400 a month, starting out with $100,000. Remember the rate of return? That's the real rate of return is 3.28. Current age is 40. You end up with $276,000. Guys, look what happens. You run out of money. If you're going to keep up with the IUL, the same income that we were drawing, you're going to run out of money in the 4th year. Guys, that's pretty sad, isn't it? So let me show you how this works. So here's real life. You end up retiring with $276,000, and most folks think, woohoo, man, I've got a lot of money in there I'm going to live off of. So they take out $55,000. At the end of the next year, they get ready to take out more, and they realize, wait a minute, we're down to $200,000. How did we lose $76,000 when we only withdrew $55,000? Well, you had taxes. It grew a little bit, but you had fees come out of it too. So what happens is they realize we're running out of money too fast. So let's cut back. So they end up scrimping. They may take out $10,000, $12,000 a year because they don't know how long they're going to live. They don't know when the money's going to run out. They have no way of gauging, and so they don't have the retirement that they dreamed of. Now let's help you out a little bit. Let's remember this number here. We'll give you the statistical number of 5.04 and see how that does. 5.04. You're still running out of money after 5 years in the 6th year. And look how much money you got, $385,000. Let's say you did what the life insurance did, and that's not going to happen, but all right, 7.2. Look at there, almost $600,000. And when do you run out of money? In 9 years. Guys, look how fast it's eaten up by taxes and by the fees. $585,000. Most folks would be spinning cartwheels if they had to retire with that much money. But the IUL is going to be so much better. Now, let me tell you about the IRP. Here's how it works. This is a beautiful plan. Because you're a business owner, you're able to secure a loan. So it's reverse engineered. So let's just say you're going to draw a loan of $1 million. And you're going to deposit that. Well, the business is going to take a loan out, and then you're going to borrow from the business. You take out the loan, and then you pay the business back. Of simple interest, 3.5% is about the average right now for most cases. So we reverse engineer it. So whatever you were paying in your 401k, you're now going to pay out in simple interest only. Simple interest. All right. So now you're paying simple interest on the loan for as long as you own the loan. Let's show you what that does to the policy. So what we're going to do is change this up a little bit. And delete that line. We're going to add 200. And it's going to be annual. And that's for 5 years. So let's take a look at this. We'll show you how this works. So here you see the $1 million is dumped over 5 years, just like we did before. After that, you don't pay a dime. Now you retire with $692,000. But let's assume you're older, okay? Let's make this a... Most of you probably aren't 40 years old at this age. Let's just say you're 50 years old. Now let's take a look at this. All right? So same $1 million in there. You're 50 years old. Now you retire with $304,000 every year for as long as you live with tax-free money. Tax-free. No partner. You don't have the IRS as a partner anymore. And look at the death benefit, $3.7 million. So now you're at $3.7 million. Critical illness rider, 90% of that, if anything happens. So what about the loan? Okay, so you've still got the loan. When you sell your business, you liquidate the loan. It becomes a liability of the business and gets dissolved when you sell your business. Now we can always pay it out of the amount that's grown. But we'd rather not do that. We'd rather want to keep the tax advantages of it, and you'll end up with more money in retirement. So there's more than one ways to do it. But it is important to know that we will work with your CPA. All right? We always work with a CPA, so you'll feel good about it. He's going to sign off on the project. Most of them don't know what's out there, so we're going to explain it to him and bring him up to speed first. So there's the program. Because it's a business loan, your contributions are tax advantaged. You get to deduct them on your taxes. Because it's an insurance policy, it's tax-free distribution. Tax-free, guys. Death benefit is huge. Should you have a heart attack, stroke, or cancer, which 7 out of 70% of us will by age 65. All right, that's kind of scary too. There's no limits. We can dump millions in here, and there's no market risk. Now, guys, if that's not a golden plan, I don't know what is. So I hope you'll consider it. If you want to move forward, here's all you have to do. Here's your investment, 30 minutes of your time. We want to get you on a three-way call. We're going to talk to some experts who will be able to answer your specific questions, who will be able to give you an idea of how much you could put in there depending on what your current payments are into your retirement. We'll find a way to help you one way or another. And, guys, you'll have a retirement that you can count on. So thanks for watching. I hope you'll get back with the person that sent you this video and spend 30 minutes and secure your retirement and have the retirement of your dreams. Thanks for watching.